Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LevFin Insights Levered Lines. I'm Steve Miller, a member of the CreditSights team at Fitch Solutions. Today, we're talking with Soo Kim about perhaps the most important loan market theme of recent years, liability management transactions. There's no one better to address this topic. Soo is a partner at Anchorage Capital, where she leads the firm's global performing credit business, including its CLO platform. Like many Anchorage partners, Soo has a heritage in stressed debt. Before joining the firm in 2009, in fact, she was a member of Goldman Sachs' distressed credit team. Outside her day job, Soo serves on the board of the Korean Finance Society. Finally, Soo is a most valued friend of the family here at Fitch. Soo, thanks for joining us today.
It's great to be here.
Okay, let's start with the table setter. Can you give us an overview of your business at Anchorage?
Yes, absolutely. Anchorage was founded in 2003 as a multi-strategy credit fund. It was one of its earlier kind that really tried to bring together deep fundamental research, which at that point in time had a more of a, buy and hold bias with much more actively traded strategy overlay. That DNA is alive and well for us today. We manage about $27 billion of client capital, and we consider ourselves to be a really specialists in tradable credit. So that, of course, includes the world of leveraged loans, high yield, structured credit, and down the risk spectrum to opportunistic credit. We issued our first CLO in 2012 and have been growing that business since. So we're pretty frequent issuer in the CLO market.
Yes. And then talk about your career arc. I guess your career really forged in some period of stress back in the day.
That's exactly right, Steve. So I started in the business in 2001. I joined Goldman Sachs, and I was part of a team at the firm that had the privilege of investing the firm's balance sheet into interesting distress opportunities. When I think back at that cycle, 2001, that was, of course, the year the US economy fell into a recession catalyzed by the attacks of 9/11 after many years of exuberant debt issuance, particularly in the sectors of tech and telecom. But you compare that cycle to the '08 and '09 financial crisis, as well as the recession that was led by the COVID-19 pandemic in 2020, you had some similarities in that, you had a period of exuberant spending
Yes.
and debt issuance, followed by a period of economic deterioration, mind you, different magnitudes, right? And in different quantum of time. And so when that happens, many of these companies need additional liquidity, and the defaults are driven by payment defaults,
Yes.
right? So because there's liquidity that dries up in the capital markets and loss of investor confidence. So these companies default because they can't meet their funding needs, their financing needs, and certainly they face struggles in refinancing their debt maturities. In contrast, the recent 5 years, the elevated levels of defaults have been driven by liability management transactions, which is the topic du jour today. And these are really premeditated, orchestrated defaults in order to infuse these companies with additional liquidity, as well as increase equity optionality for the sponsors.
Absolutely. And is that the reason you think that these LMTs have taken off in recent years?
Yeah, so LMTs are really a product of the 2021, 2022 era, right?
Sure.
So if you think about 2021, we were in an environment where interest rates were really low, and therefore valuations were really big,
Yes.
right? It justified very big valuations, and there was pretty frenzied level of leverage buyout activity. And on top of that, and maybe getting a little bit less attention, is the fact that a lot of these companies had abnormal earnings, right? So some companies were under earning, but many were over earning, benefiting from the vast amount of stimulus that was put into the economy, as well as the pent up demand that was coming out of COVID-19. So roll forward 2022, what do you have? You have rampant increase in interest rates. Rates went from 0 to 5 in effect, right? And all these companies are spending every single penny that they have in excess to finance themselves, really to pay for interest. So they have limited ability to grow. And on top of that, the amount of debt that's on this business, because the valuations have re-rated down, are feeling increasingly insurmountable. So billions and billions of equity capital that's gone into this business, these businesses, it's feeling increasingly out of the money.
Yes. And now this is a question in this topic I would be excited to ask you about, because some of this goes over my head, which is the broad types of LMTs that you're seeing come through the market.
Right. And there are a lot of different flavors.
Yes, there are.
Right. And a lot of fancy industry jargon to go with it, be it an up tier or drop down and double dip. But I thought it might be more instructive to talk about what is the point.
Yeah.
Right. So, what is the point of these transactions? And going back to the amount of leverage that's on these businesses, the first and foremost thing that LMTs try to do is give funding, additional liquidity to these businesses that are running out of liquidity. But in contrast to prior cycles, there's plenty of liquidity in the system.
Yes.
And because the documents are so loose, and you know this better than anyone, Steve, because the docs are so loose, the ability to give these companies capital in a relatively safe way by putting it at the top of the capital structure or maybe putting it against some collateral that is not tapped. There are plenty of ways to do that. But what LMTs, the ones that we're talking about today, also try to do concurrently is to deleverage the structure. So this is what I call a hard conversation or a come to Jesus moment
Right.
between the sponsors and the lenders, where they come together and the sponsor is saying, hey, we need liquidity. Let's give this company another day to live. But on top of that, I need to be working towards prospects of real equity value. So I need you to take a discount. Now, the interesting part is loose stocks give the company and the sponsors a lot of stick to coerce a transaction, but there isn't a real discount capture transaction that could be done without, a lot of litigation risk unless there's an agreement,
Yes.
right? So that is what you're trying to orchestrate in these LMTs transactions. When we study these transactions, one of the things that we really look at is how overlevered is the business, because that really instructs the amount of discount capture that may need to happen.
Yes.
And when that number is really large, that's when you have this, non-pro rata lender on lender violence that can ensue, because, the pie is only so big, right? The participants with leverage are trying to recut the pie, and they're only willing to take a certain amount of discount or improvement in value. And that's when you have more aggressive behavior that take place, even if it's at the risk of litigation risk.
Interesting. So let me pick up on a point you made there about documentation. Obviously, my excellent colleagues at Covenant Review are really focused on tracking blockers and all this sort of thing. Have you found any of these documentation points helpful in any way as a lender in these situations?
I think you know the answer better than me. This one, but it's a defeating question. And, market docs are loose and there are holes and gaps everywhere. And that is market,
Yes.
right? And some of the best businesses with, the largest margin for error have the worst docs.
Yes.
So it is certainly not a defining feature in whether we make the investment or not. I think the most important thing is we're really trying to invest behind businesses that do not deteriorate, such that they have to participate in these transactions. But I guess maybe the short answer to your question is we do look at the documents holistically. We try to understand whether there's any features in there that is considered non-market. And with respect to the market terms, we are, trying to take a look at the total leakage package, some of all of the different baskets, to get a sense on how coercive can LMT be should this company have to participate. Now, if you're a smaller lender, or if you're planning to be a smaller lender in some of these transactions, I think the one prong that is worth maybe a little bit more attention, because it punches above its weight, is the terms through which you need affected lender, not majority lender, because that can help you out from time to time.
So this idea around voting rights, certi block, whatever you want to call it, that's the one that you would really recommend.
Exactly.
There. So this is a broad question, but on net, which constituencies do you think have been the most helped and or the most hurt by these LMT transactions?
Right. So out of the gate, the issuer benefits,
Yeah.
right? They get the liquidity that they need and they can fund their business and use the liquidity for the purposes of living another day. And certainly out of the gate, equity value improves, right? To the degree that there was discount capture, which is common, and that optionality benefits day one. That being said, these transactions haven't been successful for the most part in getting these companies to a normal way refinancings,
Interesting.
right?
Mhm.
So ultimately, when these companies go in for a more fulsome recapitalization or restructuring of the balance sheet, most often through the Chapter 11 process, I think the real beneficiary would be those lenders that were able to improve their recovery through the LME transaction. So it's not that they benefited, but maybe they lost less than what they could have.
That's interesting. So that leads me to my next question, which is when you think about a scenario, are there different signposts you use for the what I like to call the clash decision? Should I stay or should I go in this scenario?
Right. So that's a great question. And certainly it changes with the market. I think in the beginning, in 2022, when these transactions started to increase in popularity and prevalence, there was a lot of confusion. And I think there was a lot of confusion because these transactions were so novel and so varied, and the bookends were really wide.
Yes.
And you contrast that with very long history of the asset class having reasonably high recoveries
Yes.
in the 70s,
Yes.
right? So I think it was difficult to assess. Now, fast forward 2 more years into 2025, the experience has been that these transactions don't do well,
Mm.
even post, right? They don't trade well. They haven't gotten to a normal way refinancing. And the percentage of restructuring is probably understated because we're still in the process of doing step one,
Yes.
right?
Yes.
So I think just sell fast and ask questions later. That mentality has really become popular. But the only honest answer to your question is that it depends. It depends on the price,
Yeah.
first and foremost, versus the economic value of the instrument that you're holding, right? And it also depends on who you are as the lender and whether the transaction might be non-pro rata, in which case you have to determine,
Yes.
which group are you going to be in. So I think the right answer to your question, despite the fact that practically it's been probably the right call in most of the scenarios to sell early. And we found in our studies, if you are 12 to 18 months ahead of the actual transaction, you end up getting out at a reasonably high value with a lot of value preserved.
Yes.
But, certainly that can change with markets as well. So, our answer is you really have to think about where is it trading and what is the economic value.
Right. Makes a lot of sense. So this is more of like a broad market question, but I think something that folks will be interested in. 2/3 of the Fitch default rate over the last 2 years has been in the form of these LMTs or distressed exchanges versus an old fashioned Chapter 11 payment default. And when you think about how people frame topics like default rates and recovery rates now, how do the LMTs fit into that? Because depending on where you are in either side of that, it could be a very different experience.
Right. I mean, I think that's exactly right. So we think about it in the form of losses,
Mm.
right? So, you can use whatever variables you want, but what are the actual losses for the instrument that you own? But, I think it's more market standard to think about defaults, including the distress exchanges.
Yes.
And if you think about that, because these exchanges are bringing forward defaults and defaulting again, I think from that lens, it is reasonable to assume that the level of defaults, all else equal, including macro, can lead to elevated levels of default. But the more acute takeaway is the point that you make, which is you can own the same tranche of debt, but severity or the recovery on that piece of
Yes.
instrument could be vastly different. So I think that is probably the more important input into market assumptions as well as CLO modeling assumptions.
Right, because the old days, the CLO model was whatever, 2% default rates, 80% recovery, or 70%. And it seems like now it's a little more subtle than that. So we have a colleague here on the Fitch ratings side named Josh Clark, and he ran some numbers that I interested to get your tummy test on. He looked at a bunch of situations we've tracked on LMTs and found that priming lenders ended up about 20 to 25 percentage points better than the prime lenders in those scenarios.
I mean, I think that generally sounds right to me, but of course, you also have situations where if you're part of the lender group that is recovering more of your recovery in a junior instrument and it leads to a default, it could be much more accentuated than that delta.
Makes a lot of sense. Okay, so final question for you. How do you think these LMT executions will evolve in the years ahead? Are you seeing any trends that are noteworthy?
Right. So good question. Look, I think LMTs will ebb and flow just like everything else in the market. I am really interested to see, in light of the fact that these transactions have been not successful
Yes.
by and large, whether there is a real push going forward to set these companies up for better success. So what does that mean? Well, there's still too much leverage,
Yes.
right? So that probably means more new money, more deleveraging, but potentially, sharing in the ups as well. But, the will has to be there to participate in that kind of a transaction.
Makes a lot of sense. That's all the time we have. Thanks, Sue, for your excellent observations today. And thanks to our listeners for tuning in. Please catch us next time on our next LevFin Insights Levered Lines.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.